Is the show that helps you manage your finances. I'm Dumisho Greater. And in this edition of the show, we'll be taking a look at gas as a cheaper alternative to petrol. And in our cover story segment, we'll unpack why the National Employers Association of South Africa is taking the Metal and Engineering Industry Bargaining Council to the Labour Court. And in our Trade of the Week, we take a look at Richemont. Then in the big debates, we look at the efficacy of the collective bargaining system. But first up, we're going to take a look at the trend of the week. Before we do that, do remember that you can send us your comments or feedback on Money Matters at abn360.com. Environmentally friendly and more affordable than petrol, compressed natural gas could be a game changer for the South African transport industry. CNG Holdings is a local supplier of natural gas to industrial customers and is now responsible for 448 South African taxis that are running on fumes. Stephen Rothman, he joins me now in studio to discuss what this could mean. Stephen, thanks so much. Firstly, how popular is this and how does it work? How is this different from using just normal petrol?
Internationally, it's grown significantly. It's been introduced into this country in the last 3-4 years. We've seen uptake on it. We entered the market in about 2013 with the help of IDC, and with that we created a fund. And what happened is, with the fund, we suddenly saw a lot of taxis come on board. They're saving significantly, and the market is significant. If you look at the taxi market, there's 285,000 taxis, and with them saving between 30 and 40%, it's promising to be a significant growth.
So can any taxi use this? What needs to happen for them to start using natural gas versus petrol?
Generally, any petrol-driven vehicle can be converted very simply. It's about a 5 to 6 hour conversion process. We've set up 3 independently owned workshops that have been trained from, we brought out Italian technicians to train them. And basically they bring in their vehicle, the kit gets put into the vehicle, and they can switch over, so they can run on gas. If they're nowhere near a gas filling site, they switch back over to petrol.
How much does this cost though?
It's, the selling price litre equivalent is $9.99. Gas is regulated by NEASA, so there's a VAT element in the $9.99, but we built in 126 per litre equivalent for a fund. So people that fund their own vehicles, they would get 126 cents per litre discount.
But Stephen, the cost for the conversion, how much does that cost?
Conversion is roughly about 19,000. That would include your cylinders and your regulator and switchover system.
So in the long term, this is a lot cheaper to convert your normal car to be able to take natural gas. But in terms of going to a service station, we all know where to find your petrol station. Are there a lot of them in the country if I now had a natural gas converted car? The problem, that's one of the big obstacles we face, is expanding our network. And we built a flagship filling station in Langlaagte. We're busy looking at opening up a retrofit where there's existing diesel and petrol sold. And our rollout plan is doing both, where we offer existing filling stations options to have natural gas on their forecourts, and we would supply them with gas. The target market initially would be taxis, people that are running routes coming back on the same route. And then as the industry grows, you'll find more and more filling stations opening up. Now, the take-up from the taxi industry, you mentioned there are a couple of thousands of taxis on the road. We've got about 448 at the moment that have taken this up. Is there a big enough drive to get them or to incentivize them to convert?
Well, basically, the savings is huge for them. The benefit for South Africa is obviously emission reduction. You're looking at 25 to 30% immediate emission reduction. So driving on the savings, taxi owners are saving up to 4,000 Rand a month. So you're talking about between 40 and 50,000 Rand a year that they're saving switching over to gas. And then over and above that, we're creating awareness. We go on to different local radio stations. We have awareness campaigns at taxis, teaching people about natural gas, how it works, because they seem to get confused between natural gas and LPG. So as they've become more and more aware, we find the taxis becoming ambassadors for us and promoting it.
Oh, this is really a fascinating trend that we'll be looking out for. Hopefully we'll get those numbers right up, especially if it means lower carbon emissions. Thanks so much to our guest. That's Stephen Rothman. He's the Managing Director of CNG Holdings. Time now for us to take a look at our Finweek Punt of the Week. Luxury goods company Richemont owns top-end brands like Cartier, Alfred Dunhill and Mont Blanc. Subject to economic whims, the company's profitability rises and falls, and that's depending on consumers' access to disposable income. What does the future hold for Richemont, and more importantly, should we be investing in it? Joining us from Cape Town live is the Finweek contributor, that's Moxima Gama. Moxima, I know you were initially very bullish on this particular stock, but now you've cautioned it. Why?
Well, to be honest, I've been cautious on the stock. I've been cautious on it from the beginning of the year. On technical analysis basis, it was because it was starting to top out quite significantly and trading sideways. So that was already a sign that the bull trend was getting a bit exhausted, which is a bit normal because Richemont has had its opulent days, and a correction is well due at this point. So I've gone from bullish to caution because it's particularly broken out of a head and shoulders pattern, which means we should anticipate more downside, at least in the short term, to around the 78 levels. So if one is thinking of going long at this point, I'm afraid you'd probably be catching a falling knife. Don't be fooled by the upside we saw last week, because it's usually called a dead cat bounce, and all the indicators are still quite bearish on Richemont.
So with the economic data, I know that China is obviously a big market for Richemont, but with the data that's been coming out of China, does this just reinforce the fact that one should really be cautious when it comes to Richemont?
Yes, you really need to be cautious at this point. Look, in the long term, luxury goods service is a sector that you want to have in your portfolio, because it's now termed the affluent society, which is particularly in Africa, is growing, and luxury goods have become very prominent. So in the long term, it does have a trend that's going to be on the upside, but in the short term at this point it really needs to correct, which is quite healthy for a bull trend. You can't have something that goes up indefinitely. So this pullback could just bring it back to nice prices, which will possibly be nice cheap prices to get in. But if you're thinking of going long at this point, I think I would caution you to just hold until the downside objective around 78 is met before you start initiating any long position. And if you are highly exposed, I would strongly suggest you reduce your exposure, because there is some downside that we anticipate.
Now, Moxima, you said that if you were going to get into the stock, it would be like catching a falling knife. What, in your view, would change your opinion of this? You've mentioned that you have to wait now. Going in short is a great idea. You have to wait for certain levels. So what exactly do we need to say, okay, if X happens, then that means that's your chance to get in long on the stock?
Look, it would have to trade above its prior high, and I think a good sign would be around the 104 or 106 levels. For as long as it continues to trade below that, it means we're still in the correction, and it seems to be struggling to go above that 98 level, which was initially what it breached to confirm the head and shoulders pattern, which is a bearish reversal pattern. You'd start nibbling at around 105, but any level below that would just reinforce the fact that we are in Richemont is in a correction, and you should rather wait because there is more downside, and you just don't want to be long in a falling stock.
Oh, thank you so much. That was the Finweek contributor Moxima Gama from Cape Town saying trade cautiously. Up next, we unpacked this week's cover story. The National Employers Association of South Africa will return to the Labour Court in Johannesburg today. The organisation, they hope to prevent the Metal and Engineering Industry Bargaining Council from requesting the Minister of Labour to extend the July 2014 agreement. Now, this is between the Federation, CIVSA and trade unions to parties and employers who were not part of that agreement. While in this edition of Finweek, we delve into the business around NEASA's application and what the outcomes of this case will mean for the local labour landscape going forward. Finweek's editor, that's Jana Maree, is in studio with me to discuss this. Jana, perhaps let's start with why you decided to do the story.
Look, it kind of, sometimes you're lucky with a weekly paper or magazine. We decided we wanted to do a labour story on the bargaining council issue, which hasn't, it kind of has fallen off the radar after NEASA settled with the big, with the MEIBC and representing a lot of the big employers. NEASA said, no ways, we can't afford this, and our members will have to shut shop. And it's, for the first 2 weeks, journalists keep covering it, and it just kind of fell off the radar. But the court case has been going on, and we should be hearing a ruling today, which will have potentially major implications for the bargaining system in South Africa. And especially for small business, it might bring some good news, where you can't be forced. Basically how the system works now, you have a party the size of ArcelorMittal, they say, yes, we can't afford a strike, we'll settle on 10%. But you have a small shop employing 50 people, and 10% may just not be realistic. And yet the way the system works is that the small employer will also have to pay the 10% regardless of what they can afford. So what NEASA is trying to achieve is to get more flexibility. And I think we were lucky in terms of, with the NEASA expulsion from COSATU, Labour has been big news this week, at least until last night with what was happening in Parliament. So it is a very interesting story, and it's very important, and we'll see what the judge rules today, if there is a ruling today. I'm not sure how long that hearing will take place in court. There's no news at the moment yet. So it will be interesting to see. And like I say, I think for small business especially, this can have major implications, and also in other industries.
Well, Jana, thank you so much. You're packing a lot in a very short space of time. And that was our Finweek editor, Jana Maree. Now, still sticking with labour issues and looking at the mining space specifically, Lonmin's chief executive, that's Ben Magara. He's our guest for this week's CEO interview. Now, Ben Magara spoke with CNBC's Jeff Cutmore about a program Lonmin has put into place to improve its performance. Let's take a look at that interview.
We have begun to see the benefits already. The targets we have set ourselves and the benefits we have seen are in excess of 2 billion rands in the next 3 years. We are already beginning to see improvements in our specific shafts like Safi and Hosi, and in the whole business. We have also reviewed our operating model to reduce costs in overheads and redeploying excess labour, and that has begun, and we are seeing those benefits already.
And as far as the industrial dispute is concerned, we can put that behind us. There's no likelihood of a flaring up of problems in labour negotiations.
Jeff, we signed a 3-year wage agreement. 1 year is already gone, so the current agreement will go until June 2016. Since then, Lonmin has embarked on a drive to improve and rebuild relationships with our union, and we actually have had 2 days of a workshop where we have mapped out all the issues that we need to cover. And fortunately, we have agreed with our union that the success of our business is critical for them as employees and for us as a business. And I believe we have created the stability required through this 3-year wage agreement to take our company forward into a sustainable space.
Well, ultimately, the company still needs higher platinum prices, surely, in order to fund capital expenditure and in order to be able to pay the workers the sort of pay that you would like to give them for the awful job they do. Is that not right?
You're absolutely correct. It is. We await prices to get better. However, we are not sitting back and waiting for the prices. We are doing everything in our space to reduce costs, to improve productivity and efficiencies, to increase capital efficiency, and therefore, when prices finally turn, and they will, we will benefit even more.
When is that going to be, Ben? I mean, you're as close as anybody else is to what's going on in the mine and what's going on in the marketplace. Do you foresee a pickup in pricing anytime soon?
The current fundamentals of demand, we are seeing the gross automobile vehicles increasing even in Europe in total. Growth in jewelry, which is the second market, is also continuing to grow right now. So all the fundamentals point at better prices. The subdued supply from South Africa, given the strike, has taken out 1.3 million ounces. So we expect prices should have been getting better by now. However, the current prevailing macroeconomics, which I'm sure you and me have challenges with, and the improving US dollar, is a challenge to us. We have no doubt it will come again.
And just to take you back to Marikana for a moment, I mean, there continues to be this argument that there are culpable members of the company still that should be brought before a court. Do you see this going away? Will there be executives in front of a judge? What ultimately is going to happen in your analysis, Ben?
We have, as Lonmin, consistently supported Falam Commission and Judge Falam in his process, and we await his conclusions, which will be shared with the President. And the commitment in line with that commission is that the President will come back to South Africa, hopefully March next year or mid next year. And therefore, we have committed our support to make sure all the learnings from what happened can be put on the table, and we can all learn to go forward. We believe, as Lonmin, we continue to drive for that support to make sure Falam can come up with its findings.
We're heading into a short break, but when we come back, we'll be debating the relevance of collective bargaining. Stay tuned for that.